Hey guys, in this video, we're going to actually talk about a topic that I'm pretty passionate about, and I think it's a good one to discuss, and probably something that anybody who is about to buy a home, it's a common question of whether you should put a down payment on a house or not. And in this video, I want to cover that specific topic of the pros and cons of putting a down payment on the house, and of course, the pros and cons of not putting a down payment on the house. So let's go ahead and jump into it. Okay. So what you should be seeing here are basically two of the exact same screens. And this is actually my website, Workforce 2080. I have created this website as a way of helping employees calculate things like taxes and even mortgage payments and paying off your house early. So I figured this would be a really good topic, but I have two exact mortgage payments side by side, and I am using my specific scenario for the house that I'm sitting in right now recording this video. So I'm using the exact scenario that I have with my home, just so you understand the difference, and that way I can compare both of them so you know exactly where I'm coming from. So the listing price of the house that I'm sitting in right now is $244,000. That was the listing price. That was what I agreed to pay to the buyer to purchase this home. So $244,000 is what I agreed to. And the mortgage rate is solidified and locked in at the moment that your loan is secured. So that typically happens even after you have gotten to that point. There are several steps you have to go through before you even get to it, but 3.85% was the rate that I got. It was right in 2022 that I secured that loan at 3.85%. Obviously, things are a lot different now. As of the date of today's filming, it's August 30th, so you can imagine it's quite substantial, and we're probably in about the 7.9 range or about the 5.8 range with mortgage rates right now, so I got a really good rate. 30 years is the life of the loan. That's the one I chose. If you go less than that, totally fine, but your payment will be higher as a result because you're obviously paying off the house faster, so you have to put more money towards it. So the payment will typically, in most cases, double. Now, on the scenario to the left, you can see that I put a down payment, and this is exactly what I put down on the house. Obviously, I had the capital or cash flow to do that, and some people are not in a scenario to be able to do that. I am very fortunate. I have saved extremely well, and I've always been very, very smart with my money, so it was a good investment choice for me, and I always looked at it as a good investment choice to put a down payment on the house. And we're going to explain the difference between putting a down payment and not putting a down payment on the house. So on the left-hand side, we have the scenario where I put a down payment on the house, and then the scenario on the right, we did not. So let's compare, should you not put a down payment on your house? So if we think about that and that statement, if we don't put a down payment on our house, basically what's going to end up happening is the payment is going to automatically be higher. So in my real life situation, this is how much I'm paying in principal and interest together. So that's going to be the payment for the life of the loan. So regardless of what I do, $911.36 is exactly what I'm paying on my loan in principal and interest. Because a mortgage is amortized, that means the payments are going to be structured to where in the very beginning, they're going to be more interest than they are going to be principal. Typically, it's about 70 to 80% of that payment in the very beginning is going to be interest. So 70 to 80% interest and 20 to 30% of it's going to be principal. So $911.36 is the payment for the house itself. That does not include any insurance or taxes or private mortgage insurance. It doesn't include any of that stuff. So again, just remember principal and interest, $911.36. But if I did not put a down payment on the house at all, basically what we're looking at is an $1,100 monthly payment in principal and interest. So over $200 more. So the con of not putting a down payment on the house is the monthly payment's going to be higher in this case. So on top of that, The pro of not putting a down payment on the house is that you actually get to keep the money in your possession, especially if you're going to go and invest that money and you're going to make more interest off of it. If you have an investment vehicle to be able to make more interest off of your money, if I had an investment vehicle where I can make 20% return on $49,000, I probably wouldn't have put a down payment on the house. I would have been okay with just investing it and letting it go forward. But the chances of me getting a 20% return on investment, I'm not saying it's impossible. I'm not an investment manager or investment person by trade, but clearly that was a better choice to me to invest it in my home because I didn't have a vehicle to put it into. So the con is your payment's going to be higher. That's the main con of when you don't put a down payment on the house. You're going to have a higher monthly payment. Now, the interesting part about it is the overall cost of the home is going to be almost $100,000 more if you look at it. It's kind of a scary thing, but you're probably looking at it and saying, well, what was the total cost of the home? Well, technically, it's going to be a little bit higher because you're paying more in interest over time. And it's pretty much the exact same from an interest perspective. So 40.75% is what it's showing here and what I'd end up paying in interest on the loan. But because I didn't put a down payment on the house on the right-hand scenario, I will be paying more in interest. It's about $30,000 more in interest payments that are actually going to be made on the house. So I'll just show you what I'm looking at. So this would be the total principal borrowed for the home. So this is how much I'm borrowing. And of course, the total amount of the interest is up here at the top. So clearly there is almost a little over $30,000 more extra that I'm going to be paying in interest. So a con of not putting more, or should I say putting a down payment on the house, is that you're going to be paying more in interest because clearly you have to pay more in interest because you're borrowing more money. That's just how it works. As we go down, the total estimated tax and insurance. So again, these are estimates based on numbers that have been pulled offline and best practices, and they have stated that it's about a 1% estimate on taxes and then 1% estimate on insurance, and that's on the listing price of the home. So technically 2% for both of those combined. So the total estimated tax and insurance on the listing price of the house is about $406.67. Now, just to give you some context here, I'm paying $391 in what's called escrow. And this is considered escrow because tax and insurance is considered an escrow account. And what happens is when you mortgage your home, most mortgage companies are going to require you to put money into an escrow account. So they're going to ask you to make a payment with your mortgage that goes towards that escrow account. And when they have to make those payments to your insurance company and your property taxes, they pull that money from what they pull from you. So this is fairly accurate. If you ask me, it's a little bit overinflated by just a few dollars, but I'm okay with that. But it also can help you. So you have to factor those things in. When you don't put a down payment on your house, you're going to have to pay a higher monthly payment. And you have to not forget that, look, I have to also pay property taxes for this house. I also have to pay insurance on this house. If I live in a flood zone, I may be even required to have to carry flood insurance on the house. There are tons of scenarios that you have to go through when you're purchasing a house. So just saying, oh, I don't want to put a down payment because I don't feel like it is probably the worst thing you can do. You always have to crunch the numbers a little bit to see, well, why should I not put a down payment? And what would be a smart choice? And what can I financially afford? So for me, I made sure and put a down payment because I wanted a lower monthly payment. And I wanted to make sure I always had enough cushion to where if I have extra, I can put extra on the house. But if I didn't, I would have a lower monthly payment. And that would be a lot more fiscally responsible of me to do it that way. But again, you should always look at your scenario, not compare yours against mine, but always say, well, look, what can I afford? And what am I able to afford on a permanent basis? Because we're talking 30 years. We're not talking 6 months. We're talking 30 years. So the total estimated monthly payment, you can obviously see it's $200 higher. So it's not that big of a difference. But again, if you're making 15 bucks an hour, and I'm making this scenario, I'm not saying that's your situation, but if you're only making $15 an hour, and let's say you work full time, let's say before taxes, you make $2,600 a month. Okay. And let's say that you only bring maybe 80% of that home after taxes and maybe deductions like insurance and things like that. Well, you're left with about $1,800. So you can imagine that if you're bringing home $1,800 on a monthly basis, basically your mortgage is going to eat away every bit of your income if it's $1,500. So it doesn't matter whether I made a down payment or not in this case, I'm still going to have a tough time affording the house. Therefore, it goes down to the principle of, should I be buying this house because it's probably too much? Like maybe you need to get a house that's cheaper, not so high. Now, the other thing that is also a con of not putting a down payment on your house is something called private mortgage insurance, or PMI. So the mortgage company is going to look at this situation and say, well, look, are you going to give me 20% of the value of the home? If the answer is no, they're going to say, well, okay, that's fine. I can borrow you the whole amount of the money, but I'm going to need some insurance off of you in order to borrow, or in order for me to put that money on you, we need to actually take some sort of collateral. So what they're going to do is they're going to put you in an insurance policy where you're actually going to pay them premiums for putting money down for you with no risk. So in other words, it's like if I came to you and I said, hey, I want you to give me $6,000. Some of you would probably say I'm out of my mind for asking that, but a lot of you might say, well, what insurance do I have that you're actually going to pay me? And I could say, well, I don't have any. And you might be like, well, give me your car. And if I give you my car, that's called collateral. That's me giving you something. And look, if I don't pay you, you keep the car. Well, that's what they're basically doing. The mortgage company is saying, well, since you didn't give me any collateral, I'm going to charge you a monthly payment to actually ensure that you can make those payments. And considering that you have a lot less risk in the game and skin in the game because you didn't put any collateral down, that's why they're charging you private mortgage insurance. So online, they've stated that the general consensus is 1.5% of the listing price, and that's what your PMI would be if you didn't put 20% down. So here's the scenario. If you don't put at least 20% down on your home, that's when the mortgage company can charge you private mortgage insurance. So in this case, with the house that I bought, if I wouldn't have put at least 20% down, I would have had to have paid an extra $305 a month towards private mortgage insurance. So clearly my payment's not just going to be $1,500, it's going to be $1,800. And guess what? That $305 is actually not going towards any part of the house at all. It's not going towards the principal of the house. It's not going towards the interest of the house. It's dead money. So I'm basically giving an additional $305 a month to the insurance or to the mortgage company just to buy the house for me and for me to make payments to them. So you can obviously see there's some additional things you have to keep in mind. When you don't put a down payment on the house at all, or at least 20%, not only is your monthly payment going to be higher, but you also have to pay private mortgage insurance if it's not at least 20%. So that also has to come into your solar system to say, look, this is important. So I'm just going to do some simple math here for you and just kind of talk through some things with you. So what I want you to keep in mind are the numbers I'm about to write down here are more of just something to keep you up to speed. So if I have to pay $305, let's just say that 20% of that mortgage, so $244,000 times 20%, it's actually going to be somewhere in the line of 48,800. So in other words, I'm going to have $48,800 as 20% of the house value. So if I divide that number, 48,800 divided by 305, let me get my little trusty calculator going on my watch here because I can't do that in my head. So 48,800 divided by 305, that's 160. So that's 160 months. Then 160 months divided by 12 gives us 13 years. Now, I want to kind of break this down even further for you. So if I say 305 times 160 payments, or times that many years, so you can have obviously think, hey, I got to do this payment 160 months. You know, that's some dead money to you. And guess what? $48,000 of your money is going down the drain. It's not going towards the cost of the house. It's not going towards your principal at all. It's strictly going to the mortgage company to pay for your home, and they're basically just taking it as collateral. So in other words, you're just paying an insurance policy on your house until you hit 20%. So that's 13 years you'll be making those payments. 13 years. $48,000 doesn't sound like a lot. And again, if you don't have that money on hand, you might be able to go and invest that 20% and make just as much on it, which chances are you will regardless. But if you think about 13 years of that payment, it's quite substantial. So don't forget, that's dead money. That's not going towards your house at all. It's strictly just giving the money to the mortgage company as collateral to say, thank you for putting money to buy this house for me. So hopefully that's given you guys a little bit more of a vantage point of why you should or should not put a down payment on your house. And hopefully I've done a good job explaining that for you. Again, all these scenarios are contingent on your financial situation. I can't sit here and give you financial advice such as, oh, you should do this in this case, because again, it's all attributed to what you can afford. Mortgage companies or mortgages for you are very personal because the amount you pay per month is contingent on what you can afford. So it's very important that you look at your own financial situation and determine, can you afford it or can you not afford it? That's really the big thing. If you can't afford it, then you need to look at the cost of the house and you need to figure out, well, okay, if I don't do this, can I afford this payment if I don't put a down payment? Can I afford private mortgage insurance? Am I okay with tossing $48,000 away over 13 years? Am I okay with that? Me personally, I'm not. I can't stand the thought of giving money away and it just being dead money. I just don't like that thought. But then again, if I were able to get 20% return on that money, I would have never put a down payment on it. I would have just put it in the market and let it just keep recurring and making that recurring vehicle of interest. So, you just have to really look at these scenarios to determine what's the best course of action. So just remember that when you don't put a down payment on a house, you're going to have a higher monthly payment and you may have to pay private mortgage insurance if you didn't put at least 20% down. Those two scenarios alone are more than enough reason to give some serious thought to putting a down payment on the house if you can afford it. If you're a doctor or you're a high wage earner, it might be okay not to put one because you're doing just fine and you're not going to have to worry about that because again, it's not even in your solar system if you're making $500,000 a year or if you're making, $600,000 a year or $1 million a year. Sometimes those things don't matter. But again, it's something everybody needs to sit down and think, especially when you're making $15 to $20 an hour trying to buy a house in this economy right now in 2024, it's absolutely atrocious. Trying to buy a home and trying to stay afloat and pay your bills, and then even the insurance market. What people are seeing now is that the insurance market is so unstable, especially here in the state of Louisiana, it's absolutely horrific. And what I'm seeing is my insurance went up $90 a month, literally just living in this house for less than 3 years, and it's already gone up to $90 extra a month for insurance. So you can imagine it makes me pretty sick to my stomach because, right off the bat, another $700, another $800 is gone a year, or $900, almost $1,000 is gone. Just like that when insurance goes up. And every little bit hurts because if you're living on a tight budget and you're just trying to afford the house, some people are getting priced out of their homes because of the insurance market. So don't forget to account for your insurance and your taxes when you're looking at your monthly payment. And also, when you look at those two factors, don't forget that if I don't put a down payment on the house, that payment is going to automatically be higher. So remember, your monthly payment is going to always be higher if you don't put a down payment on the house. And if you don't put at least 20% down, private mortgage insurance until you hit the value of 20% of the home. If you put a little bit down, like 10%, you're only going to have to pay only up to the point when you hit 20%. Once you hit that 20% marker, then you don't have to pay private mortgage insurance anymore. So hopefully those have been some good strategies for you. I hope that's been helpful. Y'all take care now.